All right, let's dive in. Today, we are cracking the code on a concept that, and I mean this literally, powers every single business on the planet, from the food truck on your corner to massive companies like Apple and Google. It's called double entry bookkeeping. Now, I know it sounds kind of complex, maybe even a little boring, but trust me, it's actually this beautifully simple system that once you get it, it's like a light bulb goes on. You suddenly see the secret that's been driving business for centuries.
So it all boils down to this one question. What's a secret so powerful, so fundamental, that it's been the bedrock of all commerce for half a millennium? Well, the answer isn't some fancy new algorithm or complicated tech. Nope. It's just a simple, elegant way of thinking about money that, once you see it, is going to completely change how you look at every single transaction.
Okay, so let's start with the absolute core idea. Forget all the accounting jargon for just a minute. I want you to think of this as a perfectly balanced system. It's a way of seeing the financial world where every single action has an equal and opposite reaction. Every single time.
And this right here, this is the fundamental truth of it all. For everything a business gains, something else has to be given up or changed. If cash comes into the business, it had to come from somewhere. Maybe a sale or a loan or an investment. Nothing just appears out of thin air. There are always two sides to the story.
And this is the perfect metaphor for the whole thing. Just picture an old school balance scale in your mind. Every time you add a little weight to one side, you have to add the exact same amount of weight to the other side to keep it perfectly level. That scale is going to be our guide through this. Its one and only job is to stay balanced, and our job is to figure out how.
So, how do we take this idea of a balanced scale and turn it into something we can actually use? Well, we do it with a really simple equation. This is the mathematical heart of the entire system. And don't worry, seriously, if you can handle 1 + 1 = 2, you have already mastered all the math you're going to need here.
It's called the accounting equation. And this little formula is basically the law of physics for our balance scale. It is the unbreakable rule that governs every financial record and provides the entire foundation for pretty much all of modern accounting. And there it is. Assets equals liabilities plus capital, or what's also called equity. Look familiar? It's a perfectly balanced equation. The left side must always, and I mean always, equal the right side. It's our scale, just written down as a simple formula. So what do all these terms actually mean? Well, it's really simple. Assets are just all the valuable things the business has. Cash in the bank, the computers, the inventory sitting on the shelves. Liabilities are what the business owes to other people. Think bank loans or bills you have to pay. And capital or equity, that's what the business owns free and clear. It's the owner's actual stake in the company, what's left over after you pay off everything you owe.
Okay, so we've got our scale and we've got our equation. Now we need a language. We need a way to describe how we're placing things onto that scale to make sure it stays perfectly balanced.
And this gets us to the really big question, right? If every single financial thing that happens has two parts, how do we actually write them down? How do we give instructions to our system?
We use two words that have probably caused more headaches and confusion than any others in finance: debit and credit. But here is the secret. I want you to forget everything you think those words mean. They do not mean good or bad. They don't mean plus or minus. They are just directions. Debit simply means left, and credit simply means right. That's it. They're just telling us which side of the scale to put the weight on.
And here's where it all clicks together. See? Debit corresponds to the left side of our equation, the assets. Credit corresponds to the right side, the liabilities and equity. So if we want to increase an asset, which is on the left, we debit it. And to keep the scale balanced, we have to increase something on the right, a liability or equity, with a credit. It's just the language we use to keep that scale perfectly level. All right, we've got the theory, we've got the equation, and we've got the language. Now for the fun part. Let's actually watch this whole system work with a simple real-world example.
Okay, imagine we're starting a small business, a little coffee cart, and our very first move is to buy the most important piece of equipment we'll need, a $2,000 espresso machine. We don't have the cash just lying around, so we get a loan from the bank to pay for it.
So let's walk through this step by step. First, what actually happened? Well, we gained a $2,000 asset, that's the machine, but at the same time, we took on a $2,000 liability, the loan. So this affects two different accounts, equipment and bank loan. Now we apply our new language. An increase in an asset is a debit. An increase in a liability is a credit. So what's our final entry? A $2,000 debit to equipment
and a $2,000 credit to the bank loan.
And this is the magic moment. Just look at how the equation works. Before we did anything, both sides were zero. Then we added a $2,000 asset on the left and a $2,000 liability on the right. So what happens after? Our assets equal $2,000 and our liabilities equal $2,000. It is perfectly balanced. The system just works.
So, all of this leads us to the final, and truly, the single most important principle that makes this entire 500-year-old system work so flawlessly. This is the one rule you can never, ever break. This right here is the golden rule. For every single debit, there must be a credit of the exact same amount. No exceptions, ever. It's the law that makes sure our scale never, ever tips, and that our equation is always true. It's the beautiful, logical core of the whole thing.
If you remember just one thing from all of this, remember this number. 2. Every transaction, whether it's for a penny or $1 billion, always has two effects: a debit and a credit. That's the double in double entry.
So why does any of this really matter? Well, first off, it's an incredible self-checking system. If your debits and credits don't add up, you know instantly that there's a mistake somewhere. It's like a built-in error detector. Second, it gives you a complete financial x-ray of the business. You don't just see that you have an espresso machine, you also see that you owe money for it. You get both sides of the story. And finally, it truly is the universal language of business. If you understand this,